I'm here with Larry Fink, CEO of BlackRock at UCLA Anderson School of Management. Larry, great to see you.
Andy, how are you?
So let's jump right in and start talking about the markets. What's going on with interest rates and how will that affect equities? Is the long bull market over?
Well, it's always great to be back at my campus, so I'm really pleased to be back at UCLA. No, I don't know if the bull market's over, but we're going through a normalizing process in interest rates. I would say 2017 was the anomaly. We all forget that. 2017, we saw record low volatility. We had interest rates really, even with the Federal Reserve raising the short rates, the intermediate and long rates really didn't move much. And now we're starting to see more normalization go on. And for big and important reasons, we have 3.9% unemployment. We have indications that we're starting to see real wage inflation. We have concern about the scale and size of our deficits. And I think that's going to be the key issues. At the end of the fourth quarter last year, we were excited about those, all the tax reforms. Now we have to start paying for it. And so there's a deep and a pretty important worry about the scale of these deficits. And with these deficits that we're facing now, we're going to see just huge supplies of US Treasuries, which between the supply of Treasuries with some whiffs of inflation, with more normalization going on with the Federal Reserve, with issues related to China, if China does the big giant reforms that they're talking about, when I hear reforms, and if they do implement the reforms, I hear inflation, because reforms mean they're going to consolidate all their state-owned companies. They're going to wring out excess supply, and they may not be doing the dumping that people are accusing them of, because they're not going to need to do that. And so you're going to start seeing China being a country that, instead of exporting deflation, maybe you're not going to see any change, but it's not deflationary, and it may become inflationary. You add all that up, I think the trend for interest rates are to be higher. And the question is, could that derail the US equity market? Not at the moment.
So you don't think we hit an inflection point in the beginning of the year? I mean, a lot of people are saying that burst in January was the end of the bull market.
That was a burst. It may become the end of the bull market. I don't think we have enough evidence. Clearly, we were having record earnings, and record earnings are not stimulating higher prices. And I think that's another indication. I would also say, Andy, as you know, we are seeing record M&A. Record M&A always tells you that we're at the last stage of an economic growth. Generally, when CEOs do these record amount of mergers, it tells you they're worried about their future growth. And so they do these big giant mergers. Now, that's conventional wisdom. The record amount of mergers just may be as a result of the tax reform that now most companies they have as much as 18% less taxes, and so their free cash flow is enormous, so they could be using that for M&A. But I would say all historical indications that M&A is a late stage economic indicator, not an early stage. And so you add that up,
right.
We'll see.
And a flat yield curve, are there opportunities and risks there? Does it signal a recession?
No, I believe the flattening of the yield curve was indicating to me that we still have record pools of cash. And if you look at where US 10-year rates at 3.10, if you look where German rates and Japanese rates, I mean, it is a great advantage for foreigners to be buying our rates. And so that's keeping the yield curve flatter than normal. I don't believe it has any indication of a recession. And I think it's just the dynamism of global markets.
What could be a catalyst for the next leg in a bull market, or even further economic expansion?
Well, I think that's going to be the next indication. You have the Atlanta Fed forecasting a 4% second quarter economy. The capital markets is actually saying, it's not growing as fast. But if indeed we see from all the tax reforms, if we see the economy growing at 4%, plus corporate earnings as strong as they are, we will have another leg up. Now, if the capital markets are right, that the economy is just not growing as fast as maybe some people are forecasting, then I believe we have another leg down. I think we're entering a real pivot point right now, a real inflection point now. The problem is if we don't have an economy that's really driving faster growth, then the issue that I talked about earlier, the deficits actually get worse. But if we have an economy that's growing way above trend line, and we're getting bigger and bigger tax receipts, then obviously the deficits will be not as difficult and maybe a little more manageable. You have, when the tax reform was passed, there was, from the White House, from Congress, many people stating that we're going to enjoy a 3+ economy for years to come. And that's how we can afford the big tax cut. If that does not happen, then we have much greater problems out 18 months and 24 months. So I am not as fearful that we are in an inflection point with a decline in markets today. I'm probably more worried out that 18 months. And so I think we're going to be in a trading range this year. But we'll see. We have a lot of data that we're going to have to digest. We're going to have to see how our trade talks with China go. We're going to have to see how strong of transformation we're going to see from the Xi government in their reforms. We'll have to wait and see, is there a NAFTA agreement? I do believe, Andy, all that uncertainty is probably causing some people to pull back.
Right.
And I should say one other thing. Japan had a very negative first quarter. Japan actually recorded a -0.6, and that was not what everybody thought. Japan had for 2 straight years a positive GDP. You're starting to see economic indication in Europe just marginally slowing down. And so all of this, all of these issues are giving you mixed messages. Until we have more certainty, we'll know where that inflection point goes.
All right, you mentioned NAFTA and China, Larry. What do you make of the president's trade policies?
I'm a globalist, and I believe we have, the majority of the world, the majority of Americans have truly benefited from globalization. Not all. I do believe there's legitimacy in renegotiating some of these treaties. NAFTA is a treaty from 1994. Capitalism takes advantage of law. And in many cases, I think many people took more advantage of where we are. And so it is proper to relook at a 1994 trade treaty. I think everybody can say positively that China has probably been more abusive in terms of their trade policy. They probably have not lived up fully to the WTO. I do believe the economic team of China is as strong as any economic team in the world today. Larry is now negotiating presently today at the White House on a reconfiguration of our trade agreements with China. There's legitimacy for a renegotiation. But let's be clear, China has, in my mind, more cards than we do. China is our banker, okay? Generally, when you borrow money from a bank, I don't know how successful a strategy is when you try to harm your banker and they call your loan. The United States is in a very unusual position, getting back to our deficits. Andy, 40% of our deficits are financed by foreigners. That is not a good situation. And so if we now disrupt, I would say, the ecosystem of the global economy, could a trading partner be so upset that they're not going to buy our U.S. treasuries? Now that's a pretty large thing for any country to do, especially China, because China is so, they spend so much time focusing on their valuation of their currency. So if they dumped their $1 trillion, which they own of U.S. treasuries, it would push down the value of the dollar, would raise the value of their currency. And so it would be a very difficult thing to manage. But let's be clear, China is the owner of $1 trillion of our debt. I think how we negotiate our trade policy with them is a delicate matter, and I think we should all be aware that not only, I mean, it's true we have a $370-odd billion annual imbalance between what China buys from us and what we buy from them. They buy about 120 billion from us, and we buy close to 500 billion from them. The net is that. We buy a lot of things from China because it provided cheaper products. Yep. If we create these trading agreements that ultimately means higher cost again, so the whole ecosystem could change. Could we, if China does renegotiate many of this, which means higher prices, so higher tennis prices, higher iPhone costs, and everything we get from China, could that mean higher inflation? Could that mean higher interest rates? Could that mean then the fall of the U.S. equity market? So these are not easy things to negotiate, and the outcomes could be very negative.
Right. Shifting gears a little bit, active versus passive investing. You hear this a lot, and I'm curious what your thinking is with regard to the massive amount of money, Larry, that's gone into passive investing, and doesn't that pose a huge and potentially unprecedented risk to the markets?
Well, it's not that, the flows are large, but passive represents globally about 20% of the overall equity markets. Today in the United States, maybe it's 30 and elsewhere it's 10. It's still not that large yet, Andy. And people are blowing it way out of proportion. Actually, in 2018, BlackRock, I could talk about other firms, are getting positive flows in active. There's room for both. The key that, I was talking to one of the top active managers yesterday. They're seeing very good flows, and the reason why, they have much lower fees than the average mutual fund company in active. And so I think what's going on, until many of the active managers lower their fees, and so they could prove over time they get outperform after expenses, you're going to see more flows into passive. I think over time you're going to see pressure on a lot of those active managers. They're going to be lowering their fees, and then you're going to have better outcomes in active. But this whole notion of active and passive, Andy, when we bought BGI in 2009, most people, if not all people, said that was a bad transaction. Nobody can have active and passive in the same organization. And we said, why? Our clients have both active and passive. Why can't we offer products agnostically to our client? And that's actually worked, and that's what the big transformation for BlackRock. And so, yes, we still see large flows in passive. We're seeing many active managers using passive instruments and actively manage. So that's another thing people are missing. Many people are not buying individual stocks. They're actually buying an index and getting exposures. So Andy, if you wanted to buy China, I could give you an ETF of China. If you wanted to buy India, you wanted to buy semiconductors, you wanted to buy the S&P, you could actively manage and navigate those exposures by using passive instruments. And so we're seeing many active managers using passive instruments, and that's another reason why we've seen this big boost up in passive. So the answer, I don't see a point at this time where it's going to create a real problem, and as a leading passive manager, we care about this. Okay, we need to perform. We have a huge responsibility. We manage more retirement assets than anybody in the world. We have to do our job every day. We don't believe we're in an inflection point at all. We believe passive strategies can still take more market share.
So we are here at your lovely alma mater.
Yes.
And you've endowed the Fink Center for Investments and Finance and Investments. Got to get that name right. And I just wonder, I want to ask you a little bit about higher education. Higher education's under assault. It's sort of always under assault.
Yeah.
But people are questioning the value of it. And I wonder what your thinking is about how business education in particular should change. How can it adapt?
Well, I think business education evolves with society. Maybe it evolves slower than society wants at times, and that's a push and pull. Let's be clear. Those who have advanced educations have much higher compensation than those who don't. Let's also be clear. Only 30% of Americans actually graduate college. We are number 27, I believe, in the world in college graduates now. We're actually falling behind. I don't actually understand that overall debate. If you have an education, you have higher probabilities. We could ask the question about the cost of education. That's a whole big issue, and that's a legitimate issue. When I went to UCLA, it was far cheaper than it is today, but it's still
on a relative basis.
It's still
course,
a great
right.
value today versus some of the other schools. Business schools. I think business schools are adapting well to society's issues. As you know, I write my corporate letter every year. I talk about purpose. I talk about corporations need to have purpose. I believe we're seeing rising populism worldwide. And we talked about this quite a bit this past week in many of the meetings I've been. And that could be the real pivot in the whole world as rising populism grows. We have an election in Colombia in 2 weeks. Right. The populist candidate is ahead. We have a very important election in Mexico in 5 weeks. The populist candidate is ahead. We saw that the five-star movement has a dominant role in Italy. They're talking about leaving the Eurozone, so we have some uncertainty now in Europe. So you have this populist movement moving. We cannot turn our backs to these issues and what people are saying. And it gets back to this idea. Corporations need purpose. It's
right.
beyond, in my mind, beyond just profitability. I believe if you don't have a purpose, it's hard to have sustainable profitability over a long period of time. These are some of the, what I would say, concepts that have to be a major component of business schools. Not just finance, not just accounting, not just marketing, not just economics and modeling. There has to be a component of responsibility. And I believe in the last 15, 20 years, the conversation about responsibility at times have been missing. We moved, and this is one of the biggest issues of facing America today, Andy. As corporations moved away from defined benefit plans to defined contribution plans, the entire retirement responsibility falls on the individual now. And so they feel actually more detached. And the big question is, how do we build a deeper partnership between the employee and the companies? How do we build greater long-termism so people can focus and be less fearful of the future? There was a poll, I forgot who did it, I think the Pew poll, came out I think 2-3 weeks ago now, and they asked the question, and the question was, do you believe will your job exist in 10 years? And 70% of the Americans said no. Now, I don't believe it will be that large, but that's an enormous issue that's really impacting this country, that if you believe your job will not exist, you're really frightened of your future. If you're a truck driver, you're definitely frightened of your future because you read all about autonomous trucks and what does that mean. We could go on and on talking about different industries. And so I think this is one of the reasons why we have the rise of populism. And as I said in this year's letter, there's so many people who believe governments, I'm not talking about the US, but plural, are not helping as much, and that's why we're seeing these rise of populism. And I believe it's going to be incumbent on business and business schools to focus on the totality of responsibility, not just the number one objective, which is profitability. So I'm not trying to walk away from our number one objective, and our number one responsibility is to make profits for our shareholders. But beyond that, making sustainable profits, I believe a company has to have a purpose that the employees connect with, a purpose that that their clients understand and connect, and then most importantly, a purpose in the community where you operate. So I always say for BlackRock, where we have a big business in Mexico, we have to be Mexican in Mexico. We're the largest retirement manager in Japan. We have to be Japanese in Japan. As we grow in China, we have to be Chinese. And in our home country, we definitely have to be American.
Right, right. Well, it's a lot to chew on, a
Yeah.
lot to work on. We are out of time.
Okay.
Larry Fink, CEO of BlackRock, here at UCLA Anderson School. Thanks so much.
Andy, thank you.